Hello everyone, I'm Sahil and welcome back to the channel. A couple of videos back, I mentioned that I'm investing into a certain commodity and I wanted to reveal it to you guys through a video. So in this video, I'm going to do just that and let's hit it up. If you guys are keeping up with the news, you might have heard that China just went live with a carbon trading market, and people more close to me, like in Singapore, you might have heard about carbon trading, carbon credits in the government plan, or more recently, TBS also announced that they're launching a carbon trading exchange within Singapore. So that's what initially got me curious, and I wanted to figure out what carbon credits are, and in this video, I'll be discussing just that. So carbon credits are basically permits that entitle companies to pollute the environment with carbon. That's about it. So one credit, right, will equate to 1 ton of CO2 or any other equivalent greenhouse gases such as methane. And where does these credit come from? Well, it could be like, there's two options. It could be just an allowance given by the government, or it could be through certain approved environmental projects such as, like, planting trees, planting mangroves, which have the tendency to offset the carbon in the environment. And certain approved organization will go on and calculate how much is the offset, and that will be converted into credits. So these are the two places you can get credits for. Further, the carbon trading market can be split into two different types. So we have firstly the voluntary carbon trading market, and then we have the mandatory carbon trading market. So for the voluntary trading market, right, this is where you're solely relying on the environmental projects, which again are started up with NGOs and approved by the world organizations for how much credits that like they approve the amount of credits, and then these credits are sold to the companies to fund these projects. And these companies, like for-profit companies, buy these credits because of their ESG. So a lot of companies are there's a push to go green and go carbon neutral, right? And carbon neutral doesn't mean that the company doesn't produce any carbon within their operations, but it just means that they are offsetting it through these projects, like, planting trees and stuff. So yeah, at the same time, now you see there are a lot of green fundings available, especially green bonds. So these green bonds, right, have a lot less interest rate as compared to the normal interest that a company would have to pay with like a similar risk profile. So yeah, in order to get these fundings, right, the companies are enticed to go green. And so that's why you see a lot of companies buying these credits who are not involved, and it makes it very fungible, right, in the form of credit. So it is openly traded in the exchange. The companies that buy it can actually sell it again to another company and so forth. So it makes it very fungible, and you're not directly just investing into a project, a green project. So yeah, so that's it. And the DBS, like I mentioned, they launched their own carbon trading exchange within Singapore, right? So this exchange is basically just voluntary, and it's kind of very smart of them to use their position as the biggest financial institute in Singapore, and Singapore being the financial hub in the region. They can use this as a leverage to actually establish themselves as also a regional carbon trading exchange. Now, these voluntary carbon trading market are not something that we can invest in. Obviously, there are companies out there that are offering us bit-sized pieces of these larger 1-ton contracts, and if you are someone who wants to go green and offset your own carbon footprint, then you can definitely go out there and purchase these and in turn fund certain approved green projects out there. But as an investor, the mandatory carbon trading market is more interesting for us. And what exactly are they? Like the name suggests, they are mandatory for the companies that are involved in it, and they basically follow this cap and trade structure. So the government, right, they will cap the carbon emissions for the entire industry per se, and then they will allot different companies within the industry a certain carbon credit according to the size of the company and the production capacity of the company. And so once they have, right, it's either distributed to them for free or is auctioned off. Within China, if I am correct, they are auctioned off, because I heard that they were thinking about how to use the money. Should they invest into green projects, or should they make investments? But this is a side thing. But either of the ways, right, for different countries, it should be different. So either they are given out for free, or they are auctioned out. And once the companies have that, right, and if they exceed their allotment at the end of the year, then they have to buy the credits, additional credits from the open market to offset their excess. And for companies, right, who might have like better technology, greener technology, which has lesser emissions for the same production capacity, they would have some excess carbon credits, right? So these companies can actually sell their credits in the open market to the more polluting companies, and that will help them generate extra cash. So it is priced out there in the open credit, and it follows the free market theory. By doing so, what the governments are actually trying to achieve is to introduce an additional cost to the businesses. So on top of your materials, manpower, utility, and other costs, right, now you also have the emissions cost. And just like any other cost in a business, the companies will try their best to minimize this emissions cost as well. And they can do it by two ways. Firstly, they can invest into technology that emits less emissions for the same production, or they can invest into technology where it absorbs the emissions, so they are not letting it out into the environment. And if they are unable to do so, then they have to buy these carbon credits and just to offset their emissions. So yeah, but normally, right, the companies will choose the cheapest way out. So if the carbon credits are cheaper for them to invest, the long-term benefits of investing into a green technology, then they will definitely go and buy the carbon credits. Hence, that's where the free market concepts comes into play. So with the free market, right, the price of the carbon credits will optimize to a level where it is cheaper for the companies to invest into the greener tech. So that's what you're looking at, and a lot of experts out there are saying that level, the price should be at $100 to $125 US dollars per credit. But the price right now it varies according to which country you're looking at. So basically, we have three main economies that have this program running. Firstly is the European Union. So European Union are the pioneers of this cap and trade carbon trading concept. So they are actually the biggest and the most comprehensive one as well, and they cover about 11,000 companies in this program. The second one is US, at least some states of US. So you have California with their own cap and trade system, and they cover about 450 companies in this program. Then you also have some states in the northeast of US, around New York area, and that system is called the Regional Greenhouse Gas Initiative, or RGGI, and that covers around 165 companies. More recently, like I mentioned, China also got into this program. They were piloting this, but now they have the carbon trading market is live, and they cover about 2,200 companies. And if I didn't mention this earlier, I forgot. That is about 40%. This companies in the power generation sector covers 40% of the total emissions of China itself. So yeah, it's very targeted right now, and obviously going forward there will be more companies and more industries that would be involved in this program. There are many other small countries that are also running these programs, and in total they all represent 16% of the global greenhouse gas emissions. Many more countries have also started their own pilot projects or are considering to do so. Within Southeast Asia, we have Indonesia that has a pilot project. Then we have Thailand and Vietnam as well. Singapore, not so much. Singapore is still relying on taxes, so which is very minimal, like 5% or so. I don't know how it runs. I haven't checked it out, but it's not the cap and trade or open market, like free market trading. It is the tax one. So yeah. Talking about the prices, right? Europe is currently trading nearly at 50 USD for per contract, and in this year it actually went up to about 56 USD. California is at 17.74 US dollars per ton of per credit, and then RGGI is at $8.69. China started trading at 7.5 US dollars, and now is at around 8 USD. So these prices are also only bound to go up as the cap goes down, right? So obviously all the companies, the countries are following their pledges from the Paris Climate Accord, right? So by 2030, they have to reduce the emission by certain percentage. So yeah, they are following that, and hence they have to reduce the cap of emissions every year. And as the supply goes down, even though the demand stays the same, right, you will see the prices go up pretty high. And yet again, like I mentioned, the optimized price for carbon credit is about 100 to 125 according to some experts. And looking at the price right now, we have such an upside here in the next 10 years, so it makes a pretty good investment. But obviously there are risks as well, and I identified two risks. Firstly, the most basic one is like, what if there's a technology that reduces the carbon emissions very fast and it's very cheap, and all the companies go and implement that. Even if that happens, right, then the countries will react accordingly and they will reduce the cap even further. So looking at Europe, right, Europe started, like, the initial target was to reduce the carbon emissions by 40% by the year 2030. However, this program is going so well that they actually this year increased the target to 55%. So if certain technologies appear that are able to reduce the carbons, right, then they will actually reduce the cap, like reduce the supply even faster. So that will balance that off. Obviously it's still a risk, like I don't know what will happen, right, but then again it's a bit less of a risk. Then the second one I identified is the geopolitical tension. So we can already see between US and China, right, there's this going on, like if China is not doing it, why should we do it? Like if the Chinese price, carbon price is so low, then why should we price the US companies so high? Why should we make it less competitive for the US companies to compete with Chinese companies? So these tensions are going around, and that was the very reason why the Trump administration, they went off the Paris Accord, and they were like, oh, China is using coal, they're polluting so much, then why can't we do it? Why are the companies, like, if we are making them less competitive, right, let's say we are adding a cost to them, then the companies may decide to move out of the country as well and go to a country where there is less of these costs, or if not zero, right? And with that, a lot of other problems comes into play, like you have job losses and so on. So politically it doesn't make a sense, but then again, a lot of people are now going towards greener side, and there's a lot of activist rallies around the world that are promoting these things. So let's see where it goes. So that is another risk that is involved right now. But anyways, let's first put these risks to aside and talk about, if you want to invest into these carbon credits, how can we do so? We can't just go and directly buy these carbon credits and hold them just like stocks. But what we can do is invest into them through certain structured investments. And I identified two such investment vehicles. The first one is offered by Crane Shares with their Global Carbon ETF with the ticker symbol of KRBN. And then we have iPath Series B Carbon ETN with the ticker symbol of GRN. Both of these investment vehicles are tracking different benchmarks, but they are following the same method of rolling over futures contract. And then the question is, which one should we invest in? Now, I can't give you a straightforward answer. What I can do is I can tell you what I invested in and why I did so. So even though, like, if you look at the performances of the two ETFs, right? First of all, their fees are somewhat similar. So if we look at the performance of the two offerings over here, GRN and KRBN, we'll see that GRN has actually outperformed KRBN. Even so, I've still invested into KRBN, and there are two main reasons why. Firstly, GRN is a ETN, which is a exchange traded note, whereas KRBN is a ETF, exchange traded fund. So whereas the notes are like a debt-based structured investment, KRBN ETF are like equity, kind of like, you have equity into the fund itself. So ETF is better protected than ETNs, and that is the reason that I chose KRBN instead of the GRN. And you can also Google the differences between ETN and ETF and figure out more of the differences if you'd like to. We're moving on to the second point, right, which is the holding. So GRN, right, they're solely invested into the European Union carbon credits, whereas KRBN, they cover European Union mostly, but they are also invested into the US side, and at the same time they are open to move out to the other countries as well as they mature. So yeah, and that is the very reason. So in the past, right, if you see European Union carbon credit prices are the ones that have outperformed any other market. They have gone up way faster than the other markets, and that is the reason why GRN has performed slightly better than KRBN, because the holdings of European carbon credit for KRBN is slightly lesser, and they also hold the US one. So that is the main reason why the performance is lower than GRN. However, I don't see that as a case to be going into the future. I believe that the US carbon credits will outperform European ones, and also if KRBN takes part in the Chinese program, then obviously that is going to outperform the European one as well. So if you just take an example of what the projections of the prices are for, like, EU, they can double. If the carbon credit prices go to 100, then obviously your returns would be 100%. But for US ones, where the prices are at like 17, then you obviously make 5x. Or if the other Reggie is at about $8, right, then it's basically 10 times or 10 to whatever times. So yeah, I see that KRBN will going forward outperform the GRN, so that's why I invested into them, and I hold about 60 units of KRBN at currently at an average cost of 34.55, and it currently represents about 3% of my portfolio, and I'm also considering increasing it to 5% if the price drops below my average price that I bought in at. Alright, so that's all for today's video, and if you think it was worth your time watching it, please consider liking the video. If you think it was a waste of time, then please give me your feedbacks in the comments below. Until the next episode, ciao.